Welcome to the Tuesday edition of FreightWaves Now. I'm Emily Zing. Today we're talking oil and have a great carrier update for you. But first, we start with Economist Anthony Smith. We're talking durable goods. How's the market looking right now, Anthony?
So right now we have a little bit of a mixed bag. As you mentioned, we're talking durable goods. So in the purple line, we have durable goods shipments, and in the green line, we have new orders. So with shipments, we saw that there was a 1.1% decline, but we saw in new orders, there was a 2.2% increase from June.
So what does this mean for the market? When we're talking about durable goods, what exactly does that focus on the economy? What does it mean?
So it means that we have CapEx investments, businesses, they buy and build machineries. It gets moved in and out of the country and all throughout the country. So in the green line, when we're looking at orders, this is something that has downstream effects when we're looking at production coming online, and then later on it eventually goes into shipments, what we have in the purple line. And so right now when we're looking at shipments, that's the actual tangible results. And in the tangible results, we see that they're coming down. So that kind of tells us that the third quarter is off to a little bit of a weak start going into the second half of 2019.
We're talking about moving things. So how does this also correlate with the freight market?
So this correlates with the freight market because when we're looking at business investments and we're looking at those businesses buying machineries, this all ties together because we're looking at, are businesses feeling confident? Are they investing? And are they moving these machineries throughout as it gets hauled throughout the country via freight? So when we're looking at orders, this is something that gives us a little bit of hope in the second half of 2019 as we move towards the end of the third quarter. Another headwind that might be into play here is going to be the preliminary numbers coming from the PMI.
So definitely something we need to watch in the future.
Something we're going to watch very closely. The numbers are due early September, and we're going to keep our close eye on this.
So we will check back with you on the PMI in September. Thanks, Anthony Smith. Donny Gilbert joins me now for our carrier update presented by AT&T Business. Donny, what are we looking at here?
So we're looking at the outbound tender rejection rates for dry vans. Nationally, the average is about 3.75%, which is relatively low for tender rejection rates. So this year, we've always had low or excess capacity, which has pushed, the tender rejection rates down, which shows that our spot market rates have been, really suppressed this year for dry van carriers. So I kind of want to start out here. This is our outbound tender rejection index using our map features. And I'm going to start here over here in the Northeast. We've actually had some a little bit picking up here, about 4 to 6% around the Harrisburg area. So this is actually looking good.
Yeah, last time we talked, the Northeast was not hot. Things weren't looking good.
Well, it's picking up.
Okay.
Boston is still 1.22%.
Okay.
So that's a very, very low tender rejection rate. Down here in the Southeast, we've got 4 and 5% starting to pop up here. So those are picking up a little bit. The Midwest is really where we've seen a lot of the strength that's been growing a little bit. We got rejection rates from 5 to 11% running through the Midwest. So here's the area where a lot of your carriers are really going to want to kind of stay. Up here, Sioux Falls is around 12%. That's a really good market. It's a smaller market and it's kind of remote, but if you can find loads out of Sioux Falls or going to Sioux Falls, those rates will be a little bit better. 12%'s a lot better than the contracted rates. When it starts picking up, over 10%, when I start getting kind of excited.
Yes.
So out on the West Coast, we've got Las Vegas at 5% and Phoenix at 5%.
Okay.
Which is picking up, which is a lot different than the LAX market, which is only like a little bit over 1%. So the LAX market has a lot of capacity, which is really keeping those rates down. And in LAX, those spot rates are below your contracted rates. So you might have shippers moving their freight from contracted rates over to the spot market because they're taking advantage of those low carrier costs.
And then we were talking about dry van here. Also, then we can look at same map, but with reefer then.
Yes, and reefer is quite a different map. The national outbound average for tender rejection rates for reefer has moved up to about 12%. So a lot different map. Reefer is probably the strongest mode of transportation that we're moving right now. So when we look over here, we see Roanoke, Virginia, 17% on tender rejection rates. It's a very strong tender rejection rate. We're around 12% down here in the Columbia, South Carolina market. The Midwest has also picked up through here. And here in what I call the poultry region, we have 25 to down to Little Rock, Arkansas, 52% tender rejection rates in Little Rock, Arkansas. So and that's feeding a lot off of Memphis. Memphis is in the mid-30s on tender rejection rates. So these right here is a really, really hot spot again. It's picking up. And if you're in the Midwest here in reefers, these are definitely good areas to keep your trucks moving in between. Moving out here, we got Salt Lake City has gained up to 20% on tender rejection rates. We talked about Idaho. The potatoes are coming out of Idaho. We're up to 13% in Idaho and still holding at 20% in Spokane, Washington. You compare that down to the Midwest, or not the Midwest, the Southern California. We're looking at Fresno is about 5.5% on their tender rejection rates. So kind of weakening on the West Coast here. The Pacific Northwest has a lot of strength, Midwest and Virginia.
A lot of great information there, both dry van and reefer. Thanks, Donny Gilbert.
Improve your fleet's efficiency with AT&T Fleet Complete, a 4G solution for tracking vehicles and simplifying ELD compliance. AT&T Fleet Complete, delivering fleet solutions for every business.
Hi, I'm John Kingston, the oil expert for Sonar, and this is the Oil Report on FreightWaves Now. It's almost September, and people in the oil industry have looking to September as the time when ships were going to start taking the old fuel oil out and putting the new fuel oil that's compliant under IMO 2020 into the ships. So you'd think, well, what's going on then? Are there signs in the market that the price of diesel as a result of IMO 2020 is starting to rise? And I'm here to tell you on August 27th at least, there are really no signs of that. In fact, if anything, the diesel cracks, what are known in the industry as cracks, have been declining. A crack is really the difference between two products or a grade of crude and a product. So in this case, the difference between the price of diesel and the price of crude has actually been dropping just maybe, over the past couple of weeks. And this is not the kind of activity that you would expect to see if the market is getting tight as a result of IMO 2020. Now, that's not to say that doesn't mean that IMO 2020 isn't going to have an impact. Let's keep things in perspective of what this rule is. This rule, unlike other environmental regulations that have gone into effect over the last 50 years, involves taking one type of product and putting it into a use that didn't exist before. So in the past, you could power ships with heavy fuel oil, and now through a variety of means, you're going to be using things from the diesel pool to power those ships. That's a very big shift. That's always been the fear of IMO 2020 in the diesel market, that diverting this much diesel-like material into the shipping market was going to create a spike in diesel prices. What's been interesting is that for the most part, most forecasters have been very reluctant to put a prediction on what's going to happen to the price. Notably, about late last month, late in July, a division of Fitch, the ratings agency, came out with a report in which they predicted a spike in the price of diesel. Now, I give them credit for being sort of out there and being strong in their forecast. They didn't put any numbers on what the spike was going to be. Is it going to be 50 cents a gallon, $1 a gallon? We just don't know. But I think that was kind of a notable forecast, because quite frankly, nobody really is predicting that for the most part. None of the mainline economists. I still think the forecast that's out there, put out by the U.S. Energy Information Administration, is the one that should probably be looked at the closest. They have kind of tried to predict the wholesale price of diesel relative to crude over time. They see it rising by 25 cents. So there's really two things here. Number one, will the price of diesel spike as IMO 2020 starts to hit? You're talking about a lot of barrels going to be diverted out of the diesel pool into another use. A spike could develop. In fact, I think it will. How long will it last? It's hard to say. The other question is, will diesel permanently be altered relative to the price of crude? That's really at the heart of the EIA forecast. They see that if, let's assume for a second that crude is steady, crude doesn't change, the wholesale price of diesel would rise by about 25 cents from where it is now, again, given standard crude prices. So we're going to be watching IMO 2020 closely here at FreightWaves. Right now, no signs of it, but it's still fairly early. Thank you.
It was great to have a cameo by our oil expert John Kingston today. Of course, you're watching this on YouTube, so hit subscribe. Make sure you also like us on Facebook, Instagram, and Twitter. Have a great Tuesday.